Thank you, Parisa. My name is Nick Halaris, and my day job is I'm a real estate investor and developer. I run a company called Metros Capital. I also write a newsletter that covers topics like macroeconomics, the ins and outs of the real estate world, and interesting topics like what we're going to talk about today, like the tokenization of real estate and the intersection of cryptocurrency with real industries like real estate. I'm super excited to be here today with all of you. Thank you for taking the time. We have a really interesting group of thought leaders, business leaders, people who are operating at the absolute forefront of an exciting new industry. It's not very often that you get to participate in something like what we're all going to talk about today, which is really the emergence of something new and dynamic, and something that I think will be an important component of the global economy and asset markets in the very near future. And today we're sitting down with some people who are kind of leading the charge in that. So before we get started, I'd like to just really quickly have my colleagues go around the room and introduce themselves to all of you. Ed, you want to start?
Sure. Good afternoon. My name's Edward Nwokedi. I'm the chairman and CEO of Red Swan CRE. We are a digital marketplace of tokenized commercial real estate. We bring sponsors and investors together to create liquidity for assets and raise capital. Thank you.
Jeff?
Yeah, hi, my name is Jeff Bromczek. I am a managing director and also chief compliance officer of Exemplar Companies. We are an integrated law firm, capital, and strategy firm where we provide services related to emerging firms such as Red Swan CRE. We've been very active in blockchain, the utilization of digital assets for quite a number of years. I also lead a compliance practice supporting firms who are delivering these new asset classes and also helping them address the regulatory requirements, both on brokerage, banking, and commodities. So it is a very exciting space, and thank you.
My name is Tyler Harttraft. I'm a partner at Bull Blockchain Law. Our firm is a boutique firm based in Philadelphia, and we were founded in 2018 to cater exclusively to blockchain and cryptocurrency companies. Today, we work with a variety of clients from token issuers to broker-dealers.
Did we lose Tyler? Okay. Well, while he's coming back, maybe we should just
to
So Tyler, we missed about 50% of that. So can you briefly just try to finish it up?
Sure, yeah. So just our firm is based in Philadelphia. We're a boutique firm. We work with broker dealers, fund sponsors, investment managers, really covering everything from securities compliance to corporate work for your emerging companies, to fintech compliance for money services businesses and money transmitters. So a lot of subcategories within blockchain, and we work with real estate sponsors.
Okay, so we're seeming to have an issue with Tyler's internet connection. So in the interest of just moving this forward, let's get started. Here's what I'm thinking as far as structure this is for the members of the audience. We're going to have a discussion, the three of us, about some very high level, or the four of us, about some very high level topics that we think are very important to cover. It's sort of like the basics of this new emerging industry. And this should be probably about half of the time that we have allotted for this webinar, and then we'll open it up for questions. And so please load the questions into the Q&A, and I'll start monitoring them as we get into this. And we'll try to answer as many as we can. The way we'd like to start this is Ed Nwokedi from Red Swan is going to give a brief overview of just what we're talking about. What is tokenization and why is it so exciting? So Ed, why don't you take it away?
Excellent. Can you guys see my screen?
It's perfect.
Awesome, awesome. Well, I'm excited to be here to talk about this. It's definitely an emerging business in the commercial real estate. I think, as some of my clients say, that not paying attention, makes some of them become dinosaurs. I heard that yesterday, and I thought it was pretty good. But it is definitely something that's showing a lot of interest, not just the United States, but around the world. We're talking to groups, large groups from UAE, major commercial real estate companies here in the United States. And even companies that are big companies that are trying to provide power plants in countries around the world. So tokenization is definitely on the forefront for a lot of industrial and commercial retail property developers as they're looking for exciting ways to create capital. As you guys know, it's a very large industry. Commercial is about $33 trillion. We've been fortunate enough to tokenize about just under $3 billion worth of real estate, mostly in the multifamily area, but that is changing. We've hired new people to bring on office, retail, and hospitality. So we'll be adding that to our platform very soon. What is tokenization? I'm just going to kind of make it simplify like I do to a lot of my clients. I mean, you're basically just taking a hard asset, and once it's been verified of the ownership, you can now put that asset onto the blockchain for recordation, which is kind of giving it a permanent position that's very difficult for anyone to hack or change, and that's what makes the blockchain very exciting. But you can take a hard asset and digitize it into either one or several fractional shares, which is what tokenization actually does. So that now that token represents that physical asset. We choose to focus on real estate because I have 20 years experience in real estate, commercial real estate, working for previously Cushman & Wakefield as executive director for multifamily. And so I saw a lot of need for this as it was taking shape in 2018, and decided to start Red Swan. The next slide here. Why is it important for you? Well, if you look at real estate in general, you have 35% of the equity of real estate is trapped into the property. And I've been doing this for a long time. Many owners try to refinance and pull equity out of their properties. And you find that it's difficult to do. When you refinance, you're only getting an incremental increase in the value of that property. And so therefore, you're not really getting all your equity out. And owners are forced to really sell their properties in order to generate their promote. And usually that means you're selling your asset much too soon. Let me just see if I can go back a little bit, because I think this skipped a couple slides. But one of the benefits of tokenization is the fractionality, as I mentioned earlier, is that you can now fractionalize in any different form, either by square footage or by the dollar value of the equity. We choose to look at the dollar value of the equities as we're using this as a way to raise capital. And so we take a $20 million raise and divide it by dollars. We have 20 million tokens that we would issue, and then issue those out to investors who want to buy fractional share ownerships by allocation. You can't buy one share, but by allocation of blocks. Maybe it's $10,000 or $1,000 allocation. Smart contracts are also very good because it helps to speed up and automate the process of issues like issuing dividends, corporate communication, capital calls. These all can be programmed into the token, so that makes it a lot easier for the sponsor and have less human interaction, which creates less errors. I think also because tokenization is on the blockchain, it's international. Anyone who can access the blockchain can actually buy these tokens and store them in their wallets. And that now makes the world much smaller in terms of international investors getting involved. I like to say the most significant aspect of tokenization is liquidity, because with liquidity now, like I said, you can pull capital out of your asset while still maintaining ownership and GP position, but also the LP shareholders now no longer have to keep their money parked in a piece of real estate for 3, 5, 7 years period of time. You're able to take it to a secondary market and trade that share based on the value of the asset, but also based on demand from the market. So you have a bid and ask environment, just like you would in the stock exchange. I like this slide because it just kind of gives an idea that when you take something up and slice it, so when you break up the capital and slice it up to smaller pieces, you actually have better pricing and people willing to pay a little bit more money for something if the cost is a lot less. So you think about a pizza, and if you break it up into slices, even though that pizza pie only costs $10, a person would be very happy to buy a slice for $2 or $3 just because it tastes good, they want it, and it's not so it doesn't break the bank at all. But it also, like I said, creates this demand from a larger marketplace, because now you have people all over the world who are looking for dollar-denominated assets that are based in the United States. And if they can buy a fractional share that gives them a certain yield dividend, it makes sense, whether that's $1,000 or $500. It now opens up the gate for many, many people to get involved. So we think that fractionalizing actually creates more value for the asset. So I was just saying about why is it important for you is that lock inside the real estate and the force of disposition. But these solutions that we're creating is that the liquidity for the LP investor is important, because as they start to see like-kind quality projects on the same block or in the same city, and one is locked up for 15 years or 5 years before they can get out, and the other one after their season period of 12 months are able to sell it, trade it. And that might just because they have a change in their lifestyle where they need some capital, or they see an opportunity where it can actually generate their determined or desired yield in a shorter period of time. They can sell it without having to consult or get permission from the GP sponsor. That's a major advantage for commercial real estate investors that had never existed before. And we're seeing that family offices and also institutional investors are kind of interested in this, because it allows them to pivot faster if necessary, and also to pivot and change into another project if necessary. So we think overall this creates much stronger yields for the GP because they now have maybe 10% interest of equity tied in their asset, and they can just continue to build their assets under management into the billions and be able to generate a nice return. And one thing that's very unique about this is that we normally think about buy, hold, and sell. And when you sell is when you start making all your profit and the GP gets most of their profit. But if you now convince or change the paradigm, and the promote is based on dividend yield, so you put a hurdle rate of say 8%, and everything above that 8%, that GP is now splitting the above incremental increase 50-50 with the LP shareholders, for example. That's a pretty strong cash flow for long term for that GP that's infinite, as opposed to looking at a 5-year hold and then selling it, and then you have to turn around and find another asset to buy, which is probably going to be more expensive and also for less yield. And lastly, we think that this is a great solution for investors because they get to democratize. You can take, rather than take $250,000, as you probably have seen currently in investments, and put it in one asset, you can actually break that up into 10 assets of $25,000. And therefore you're spreading your risk, which I think is really the whole principle behind investing in real estate to begin with. So those are basically what I had to present. I wanted to give you a quick overview. Hopefully it wasn't too fast, but I'm here to answer any questions you have. But I know there's also other presentations from our distinguished guests on this panel. Let me stop the share.
Thank you, Ed. That was great. Some questions have come in that address some of the points that you raised, but I do think we should handle them later. I just wanted the audience to know that I've seen them, and we'll tee those up for later. This is a fascinating subject, and there's a lot to unpack in what you just presented, Ed. I thought that the best way to move forward is to kind of get into some of the nitty-gritty details, because at a high level, we're talking about fractionalizing real estate and creating shares, which is not dissimilar from what people have experienced with stocks, for example, where you have publicly traded companies that you can buy and sell the shares of them. And the idea behind tokenization is that with blockchain technology, you have the ability to do this with individual real estate assets. And that's something new. So where you can go into the stock market and buy things like REIT shares or home builder stocks, like the idea that you could take a building in Los Angeles where I live, fractionalize it, and have the ownership interest of that building trade in a public fashion is something that's totally new and exciting. But it doesn't come without some regulatory and legal challenges. And I think it's important for our audience to know and understand kind of what the current framework is for the environment. And so Tyler and Jeff, let's talk about that for a bit.
Sure.
Yeah, happy to dive into that, Nick. I'll share my screen with a few slides on this exact topic. So we'll talk about practical and regulatory considerations with respect to some of the items that Ed just mentioned. So, I mean, when you're doing an initial offering, we're really, whether it's tokenized or not, we're really talking about the same regulations, because we're talking about tokenization as a technology overlay for what already exists with respect to limited partnership interests, LLC units, corporate shares. We're talking about a technology piece that represents these equity interests, or in some cases, debt interests, so notes. But with respect to the securities regulations, we're dealing with the same regulation. So the Securities Act of 1933, there's various exemptions that I'm sure people on this webcast are familiar with if they've ever raised money before. So Regulation D is a very popular exemption that allows you to raise money from accredited investors. If you use Rule 506C, you can advertise that offering. And that's really what we're looking at for the most part, as far as, or what we're seeing as far as our issuers who are looking to do raises for initial issuances, whether they're tokenized or not. I'd say that I think the bulk of our issuers are using 506C. To some extent, 506B is used when non-accredited investors are involved in the offering. I think Regulation A is also available for issuers who are usually considering much larger raises, because in a tier 2 offering under Regulation A, you can raise up to $70 million. To a lesser extent, Reg CF is used because of the $5 million limitation. So,
yeah, and Tyler, along those lines, what's important to note is the more you can raise, the more regulatory requirements that come with it.
Right, exactly.
So like a Reg A mini IPO, you're almost like a public reporting company at that point. So investors should understand that. Just, you don't have to respond to it, because the issuers are here to people who are selling real estate interests, have to take care of that. But that's just to give a guidepost in terms of why certain decisions are made and how much and what exemptions to take.
Exactly, and I think the same limitation exists with respect to not only the amount that you're raising, but the amount of investors that you allow into your raise. So to the extent that you might bump up against that 2,000 investor threshold, that is a limitation.
A public report, it becomes a public reporting company by SEC rules. What's important here, and I know we discussed it before, is Regulation S. If you want to just go through that in terms of foreign investors, that's another exemption.
Sure, yeah. To the extent that issuers in the United States want to offer interest to or tokenized securities to non-US investors, Regulation S is available. The challenge there is you're going to still need to comply with the securities laws of the jurisdiction in which you're making the offering. But certainly Regulation S is a great exemption for, or the exemption for accepting non-US investment. I'd say it gets a little tricky as far as making it a tax efficient offering for all investors, but yeah, I mean, Jeff, any thoughts on that?
Oh, no, wearing my CPA hat, when you provide access to the US markets and you make investments and you have reportable income in the United States or abroad, you may be subject to different taxation regimes abroad. So, and the United States always looks towards, well, you're in my jurisdiction, you pay me first unless you can allocate outside of the US. So to your point, and it's not a tokenization issue per se, but since this accelerates investment capabilities, all investors have to be mindful of what their tax requirements are.
Right. Yeah, it's not a tokenization issue. And I think a lot of these regulatory issues that we're talking about are not unique to tokenization. But I'd say one area that are probably in the disclosures, right, that we're providing in those offering memorandums as far as the tokenization of the security. how it works, basically educating the investor on how the tokenization is going to take place, how it's going to function, are there any risks to tokenizing, and how does that work as far as the secondary market is concerned when the tokens become available for trading. So I think that is one part of this that is very unique to tokenization, whereas it's not going to apply in a traditional offering.
Mhm. And then one last point is the technologies which allow for tokenization typically also have other aspects of the technology, which facilitates the capital raising piece and investor piece. So it's basically the whole package, and something like what Red Swan has been architecting helps respond to all of these requirements.
Right, absolutely. And kind of a sub issue, we're talking about offering exemptions here and how do you get investors into the door. But another issue is how do you structure your fund? For the most part, these funds are not going to be considered subject to the Investment Company Act because they're investing in real estate assets. But to the extent that there are some alternative assets in the fund, if any, that could really put you into the Investment Company Act status or investment company status under the Act, which can cause complications in the type or the quantity and quality of investors that you can accept.
Yep.
Great question for the group. I think everyone on this panel probably has something to say about this, and it's a really important topic. So I'm just going to introduce it, and then perhaps three of you can discuss. So one of the things that is exciting about the tokenization or the security token opportunity in the industry is this idea of the democratization of finance, or in this case, of the real estate world. So this has sort of been on the tips of everyone's tongue for like a decade at least, ever since the Jobs Act passed after the last cycle. And it's something that still isn't quite there in the marketplace. There's still sort of this blockade, which you both referenced in this discussion, and the blockade is around the regulatory disclosure filing requirements related to these different exemptions and whether or not you can take accredited or non-accredited investors. So if you think about the promise of blockchain and the promise of security tokens, it's not dissimilar from the crowdfunding promise that was started maybe a decade ago, which is like, hey, we could slice up these real estate deals that normally are only available to the ultra rich, make it more accessible to the smaller groups and smaller individuals, and thereby democratize finance. But there's this problem of accreditation. So how does blockchain, or how does the tokenization help with that aspect?
Well, I think that what you're saying is very true with regards to regulations, and I hope that the SEC slacks up on the requirements a little bit to expand the level of accredited investor, that definition, to make it a little bit more broad. But as of right now, that is a regulation to use accredited investors for the 506C, which is what we focus on. And I don't see that to be a big hindrance, because most of the investors in commercial real estate are accredited investors. And it's just different levels and sizes, from the high net worth to the basic investor to even family office investors. But I think that the real benefit here is that liquidity portion of it, for them to be able to get in and then also be able to get out. And I think that people are kind of tired of not having democratization of their investment. When you go to a fund and you have to just put $1 into, or $1,000 into a block of properties, you're buying good properties and bad properties. You don't know what the performance are of each property until they send out a report, but you're not getting exactly what you want. And I think the whole idea of the millennials and just the way things are changing right now is people want to put their money in exactly what they want and own the asset they're looking for. And now this provides that opportunity for investors, which we're excited about.
Yeah, and I think just to comment on that, the blockchain technology solution does not really change the regulatory requirements. I'd say it does make, Ed made a point earlier about institutional investors wanting to move out of these investments, and that's because the volume of deals that they're seeing is much more frequent, or much increased compared to that of a retail investor. So an institutional investor is going to have a lot more opportunities, and they're therefore going to want to move in and out of investments more fluidly. And so the opportunity that tokenization provides is the availability of a non-accredited investor pool once that 1-year lockup period on accredited investors expires. And so to the extent that you can broaden that pool of investors that can participate once that lockup expires, it bodes well for the sponsor, as I've mentioned, and for those institutional investors. And although it's not really changing any hard requirements imposed by the regulations, it is a mechanism of efficiency, driving costs down as far as being able to bring more people in the door at a later date.
Also, if you think about investing in REITs or in mutual funds, typically for the retail investor, there is going to be a load fee, some sort of fee you're paying coming in. And so not only are you buying an asset at the absolute, kind of highest price when they make it available, but you're also now paying a fee to get in, and then you're locked in for a period of time. When you're buying, at least on our platform, and I think on most that you'll see on the blockchain, that the fee is not, you're not paying a fee to buy in. So you're buying an asset alongside of the same price that the institutional or family office investor is buying. So there's no more markup or add-on for investors. And I think that's very important when you look at all the different types of investments out there in the world that are centered around real estate. Many of them have added costs, brokerage costs, or I said load fees. These are expensive, and that chews up sometimes 8, 15, 20% of your purchase, which means you're that further below and trying to get to par again over time. So it's better if you can buy direct, and it's better if you can buy right alongside of the experts, so to speak, so you're on an even playing field.
Tyler, I'm glad you brought up this point of the 1-year lockup, because I think that's one of the regulatory nuances that is important to know, but it also is exciting in the sense that there is actually a path towards a liquidity. So just to summarize, the way the regulatory framework is set up today, essentially, if you're a real estate owner or developer and you want to raise money on Red Swan, for example, you essentially have to go to accredited investors. There's limited circumstances where you can raise a small amount of money, like under Reg CF, you can raise a small amount of money from non-accredited, or even under Reg D, I think you can have like a certain number. I think your slide said 35 non-accredited investors. So right there is some options for people who wouldn't qualify to be in. But then the really interesting thing happens after this 1 year, which is the real promise, I think, of this space, which is that there's no restrictions, right? After that, like 1 year, anyone can go log on to one of these trading platforms and buy a token. Is that correct?
Right. Yeah. For the most part, you're able to include non-accredited investors, which really opens up the pool, like I said. So I think it's that optionality that really provides a huge advantage for both sponsors and those accredited investors, and it just really diversity of investors that you can accept really bodes well for everyone.
Right, and then another thing to be mindful of, the lockup, because the premise of securities laws in terms of investor protection is that the more information you can provide, the better it is for the investor, hence they're better educated and you don't have to be accredited. So when you're a public reporting company, it's very onerous. You got quarterly filings, you got with the SEC, you have all the statements, all that auditing that goes on. That's the premise of a public reporting company, which you don't have to be an accredited investor to buy. It has to be suitable for you in terms of what you want, but you're not worried because you have all the data in front of you. That's the premise of the securities laws, and hence the 2000 benchmark in terms of investors for public reporting. In the private space, private securities, the capital raising typically is enabled to people who are in and out. They have less information for them. So that's why you need to be accredited. And that's really the premise of how this is built. An interesting nuance here is that it's conceivable if a large enough project and they want to be egalitarian, they can actually do 2 offerings. It has to be managed very carefully, but a Reg CF, which is meant to be that crowdfunding, could be a component to allow access to the small investor. And then another component of the capital raise can be done utilizing those 506B or C exemption. So there are ways, even with these platforms, to provide some liquidity to the small investors in parallel. So it will evolve through time as people see, what they want to do.
Thanks, Jeff. Yeah, there's two great points there, and I want to follow up and ask Ed some questions to follow up on both of them. The first one is around this whole disclosure. So I love the way you articulated the framework for the U.S. securities laws. So Ed, how are you at Red Swan handling it? What are the requirements that you're putting on the developers and real estate owners who are putting platforms on Red Swan? What do they have to disclose? How are you approaching that issue?
Well, at the end of the day, we're selling real estate just like we did at Cushman Wakefield or at JLL. And so our sponsors have to make, first of all, they have to be reputable sponsors who have experience. We don't use new sponsors that have no experience. And secondly, they have to provide the same type of underwriting materials so that you can value the project yourself. When you have, their spreadsheet, if it's a stabilized asset, you're going to have comps, market comps, to know what similar properties in the area are selling for or renting for. So, everything has to make sense on a feasibility side. And so we look at their numbers. We kind of vet it very carefully, even before we say yes to put on our platform, but we're all in agreement on where the value of that asset is. And then to continue on with that valuation, every quarter, a sponsor has to give their financial statements so that now we can post it up onto the platform and it's on the back end where the investors have access to see where the financial performance is and engage it towards what was proposed or what was the guidance they gave when they first issued the shares. So you now get a chance to see and monitor the progress. Is it following the same line year 1, year 2, year 3 in terms of growth that they expect? So these are the way we evaluate companies when we were selling, property normally with the old way with like Cushman Wakefield or the big companies, but we do the same process with blockchain.
Okay, and on Red Swan, like fast forward, let's say it's 5 years from now, and I had acquired a security token in a secondary market. Like let's say I went on T0, for example, just to use them as a case, and bought 100 tokens. What am I going to find in terms of diligence information, and where am I going to find it?
Well, whoever issued the shares on that particular offering from the very beginning would always have an archive of the information. And like I said, on our site will be continuous updates on the quarterly financial statements. So you would be able to come now. If you're not part of our network, you might have to find other ways to bring it, but you can just ask. And I'm sure the sponsors will allow us to issue financial statements to investors. But typically, we house a lot of the informational data from the initial issuance in every quarter thereafter. So a person will have an idea of value, but also you have to understand on the secondary market, it's based on supply and demand and also bid and ask. So you see what prices of other properties are selling for in terms of shares, and you have a value in your mind based on the last financial statement you saw on the project that you want to buy. And then, there's an ask price, and you will see if that ask price, like I said, does it make sense from what you've already researched before you buy. And I think that's going to be the way the secondary market is going to move. But I have to tell you that there's a lot of resources coming into this area of the business where people are now looking at AI-driven data. So we as the industry use maybe 10 to 15 data points to come up with a value. But now there are companies out there that we're talking to that will be available very soon in terms of data that are using like 300 different data points from AI versus, the traffic on the street, the school, the ratings in the schools, the income, the demographics. All these data points are pointing to, if you have a value that's X, here is a range between below that value and above that value. And all those data points will give you an idea if it's going to be above that value or at that value or below that value. And I think that's going to be extremely helpful for the secondary market activity.
Okay.
Yeah, so what Ed is pointing to in Wall Street speak is price discovery. And that's significantly enhanced with this kind of platforms.
Yep. Another follow-up from Jeff's previous comment. You mentioned the idea of doing sort of a dual track filing where you take advantage of Reg D maybe and then Reg CF. Ed, are you doing that? And Tyler, after Ed answers, maybe have you seen anyone try to do that? Just curious.
We did that on our capital raise for Red Swan just the last year, where we had a Red CF raise. It was maximum of $5 million, but we had also some larger Reg D investors come in directly. So it was both a Reg D filing as well as a Reg CF filing.
Right, and that's investment in the red, right.
Yeah, Jeff, you know about that. But let me just say, but for the Red Swan, we don't. We only go one route, which is Reg D 506C and Reg S 506C.
Yeah, we've certainly seen that, Nick, and I think the challenge, as far as it makes sense from a traditional security standpoint at this point. The challenge is, if you want to tokenize, getting a Reg CF platform to do that for you is very difficult. Because there are not very few, if any, that currently offer that as a service. So if you are tokenizing the investment, it would really have to be later on down the road, because the Reg CF portion of that raise has to go through a regulated Reg CF portal. So,
right, it's a crowdfunding engine. Yep.
Yep. Yeah. So that's the challenge on the tokenization side, but absolutely we've seen that on the traditional side.
Right, but that doesn't not say through time that will morph and platforms will be able to support both.
Right.
Again, this is all emerging, but the beauty is, because of the platforms and the back end with tokens, you can respond to the regulatory requirements in creative ways through technology and enablement.
Okay. I think this would be a great time to actually talk about that exact issue. So the other part of this equation is this sort of back-end trading, right? That's the vision, is that there will be all this trading. So maybe, Ed, I'll start with you. Walk us through how Red Swan is positioning to take advantage of this future world where there's lots of trading opportunities. How are you handling the liquidity when the 1 year lockup periods of all these investments are over? What happens next?
Well, first of all, there is a dashboard panel. When you're a user of Red Swan and you've actually bought some securities, you have your own dash panel. That's just like a Charles Schwab account. It shows you all your holdings that you have, and there's going to be also an area for corporate communication with the sponsors. But then there's the sell button, where if you want to sell some of your shares, you identify which entity is it you want to sell and how many shares you have, so that sell button goes out. It now notifies us that you want to sell, let's say 20,000 shares if you're 100,000 shares you bought. And from there, we now have that posted on our back end, so that any of our investors who are already accredited and approved can see there's a sell order. So peer-to-peer, they can actually make an offer to buy peer-to-peer. But for even larger exposure, we would now take it to a secondary market, ATS. We have several ATS partners. I mean, there's T0, there's Templum. So a lot of ATSs that would also put it on their exchange. So there's a wider audience of investors, even broader than the investors looking at just real estate. These might be investors looking at other types of equity type investments, and they see that they'll have exposure. But we think that we will have most of the traffic on our platform, because if we're ones issuing, we have more traffic of people who are specifically buying real estate that will appreciate seeing shares of real estate being sold and be able to make offers to buy. But you have the option as a holder to port your shares anywhere and register to any exchange around the world to get visibility.
And Jeff and Tyler, maybe unpack for us what is an ATS?
Yeah, an alternative trading system. So it's basically an electronic. It's an electronic exchange that allows the buying and selling of securities. So where traditionally you had a national exchange, was a one registration, and now there's been an exemption under Rule ATS that allows you to apply for an electronic alternative trading system license. And so with the advent of technology solutions that allow these automated platforms and exchanges, alternative trading systems have really come into the fray more predominantly than service providers who are actually regulated as national exchanges.
Yeah, and to Tyler's point, the NASDAQ, the New York Stock Exchange, and those, they operate national exchanges, and it is registered broker dealers typically who operate the alternative trading. There's a fair amount of market infrastructure complexity here The ATSs have been around quite a while, Reg ATS. What's unique now is they're starting to integrate their capabilities to service security tokens. That's what we're describing here. So that's the pivot. That's the sea change that's happening in the regulated industry in securities. So and it also goes abroad. So it's not just ATSs in the United States. Liquidity can go global. So there are other touch points where these tokens can trade. So it's emerging. The use case of fractionalized real estate that's been tokenized, which are securities, these providers like T0, which you just mentioned, are basically in the forefront to help create the liquidity that you see in public markets, and it's starting to grow. It's inching, but I think you'll see a sea change and accelerate as more of these tokens come out.
And also the larger exchanges would also start looking at the activity you see on certain issuances and start to allow those issuances to be published on their exchanges as well to really broaden the marketplace. But you have to think about this in terms of a global aspect, because many of these investors are looking for ways to just hold their capital so it doesn't depreciate, right? We all know that real estate is a deflationary hedge. And so people are worried about their currency going down, their foreign currency going down. They want to put something in a hard asset that's going to hold its value. So they choose real estate, but they don't want to be stuck in the real estate for 3 or 4 years because they might need that money to do commercial business or get married or whatever. So it becomes kind of a savings account. Like when you see, banks used to offer CDs and give you 3, 4, 5% to hold your money for 5 or 6 months. Well, you think about these stock securities certificates that you're now buying in digital form, you're actually using this like a savings account, right? So you can generate a yield for a short period of time and then exit so you can use that capital for something else. So I think it just creates a brand new opening of opportunities for dollar cost average savings, but a way to hedge against inflation for sure.
And just want from a market infrastructure, just to pivot back to that and intersects with this, it is using crypto-like technologies, but it's highly regulated. There's a big difference here. So in the crypto markets, when you trade the Bitcoins, that is largely still an unregulated marketplace, which is adopting these market conventions. But since these are digitized securities, all of the frameworks we're talking about is bolting into current regulatory SEC and FINRA on the broker-dealer side, regulatory requirements. So from a safety and soundness standpoint, even though it may be a little slower to get this stuff launched, at the end of the day, this is a very safe marketplace.
Yeah, and Jeff, a point on that, I think it's a little bit nuanced, but I think it can be difficult to understand if you're not interacting with these pretty frequently. The digital security is really just a duplicate of the books and records that are kept by the transfer agent. So we're not eliminating an intermediary that keeps a record like we are maybe when we send Bitcoin to each other, you and I. We're eliminating the bank there to make the transfer. But with a lot of these products, they're really still kept on the books and records of the company or the company's transfer agent. And so you're not at risk of sending your token that represents an interest in a building that you bought on Red Swan to the wrong address, and all of a sudden that can't be accounted for. That token can be reissued, and so the risk of loss because of the things that are being mentioned as far as the regulatory considerations are, the risk is much less than in the markets with regular cryptocurrencies.
That's a great point, Tyler. I'm glad you brought that up, because a lot of people think that digital securities is similar to Bitcoin, and that if you leave in your wallet, it can get stolen or hacked. But as you said, with digital securities, it's all recorded on a cap table. So we know you're the owner. If you lose those, if you request it from us and put it in your own personal wallet, and you lose that wallet, you can't get access, we can easily just burn those tokens and reissue it to you. So you're absolutely right. But I also want to point out that cryptocurrency is really looking at this industry in a way that will give them a balance of their financial balance sheet, right? Because you can't have all your money, if money is going digital, even the US dollar, it looks like it may be going digital. So, to have all your money in cryptocurrencies, for example, you take a lot of risk, because, there's a lot of swings that go up and down with cryptocurrency. But with crypto, we accept crypto and we convert it right away to a USDC crypto before we issue a share to a customer. So that's definitely possible. And we're seeing that a lot of crypto owners want to trade their crypto in to buy real estate, digital real estate shares, because they want to have a balance so that in case they have the best of both worlds, if they're buying Bitcoin or Ethereum and they think it's going to go up, they can have that in their account as well. But they can also have something equivalent in real estate so that in case the market goes down, they still have some hard asset and a good value. And that also works well with decentralized finance, right? I mean, if you're using cryptocurrency for decentralized finance, and I hope everybody knows what that is. If not, I'm sure you guys will explain it. But it's just basically borrowing and lending of cryptocurrency based on a certain loan to value. So if you use Bitcoin for decentralized finance to borrow 60% of that equity, and you lend it out for 10% return, if Bitcoin falls down in value the next week 30%, you're going to have a margin call just like you would on the stock exchange. But if you tied that to the equity of your real estate, more than likely it would not fall down in value overnight because it's a hard asset and it's based on really real cash flow. So at least that would help stabilize that decentralized finance contract. So I think this is where we're headed in the world. People take advantage by being democratized to be able to generate cash flow from two different scenarios. Cash flow coming from the actual real estate property itself, whether it be 6% or 8% or whatever in terms of dividends, but also if that's locked into a wallet and in decentralized finance and lent out and cash flow coming from that decentralized interest, that's two different cash flows coming from the same asset you purchased.
Yeah, that's a great point. I think my observation is that there's this like symbiotic kind of relationship between crypto and real estate. What I've noticed talking to people who've become fantastically wealthy, for example, in crypto, is the first thing they do is they either borrow against their crypto or liquidate their crypto and buy some real estate. It's the most natural first move. And then people who are old school real estate, they're looking for extra yield, they'll buy some crypto. And so that's why I think this intersection. So people love to criticize crypto, saying what are the use cases and what's the use case of blockchain. I think this is right at the forefront of it because there is a real value here, and that's what makes it so exciting.
Jeff, go ahead. I'm sorry.
One question for you before we open it up to the questions on the chat. Just want to close the loop on this. So on these ATS systems, let's say I'm interested in buying a security token that was on Red Swan for more than a year. What do I have to do? Do I have to create an account like Charles Schwab? Is that basically what I do? I go sign up?
Okay, so right now, the ATS is, since we have securities laws involved and the broker dealer and a professional, or it's really meant for brokers to get access to the ATS. In reality, what ends up happening with these alternative trading systems, they also have the ability to create a securities account for you, just like you have a Charles Schwab, and they can affect the buy or purchase or sale on your behalf. So it ultimately, what's going to happen with this infrastructure, it's going to get more connected with the Charles Schwabs of the world, where through that transfer agent who's navigating the blockchain, ultimately you're going to be able to buy directly, hold it in a wallet that is serviced, and you can get a statement directly from the issuer, if you will, electronically. Or if you want, you still have your relationship with Charles Schwab, you'll be able to see a paper version, if you will, on your statement that's been digitized. That's all evolving now. It's going to take a little bit of time for that to evolve. So right now, most likely you're just going to be establishing an account at the ATS. They have a full service capability to do that. Okay. But that'll change.
That's interesting. Okay, great. Well, I think we've got some time left for there's some fun questions in here. Some
seven chats and 7 Q&A, so we got a while to go.
Yeah, it's a high level one. So I think where I want to start with on the question, thanks for everyone for submitting your questions. Really appreciate your engagement here. Is with the blockchain question. So when you think about it, tokenizing, what blockchain are people using? Like Red Swan, what is your plan? And then Tyler and Jeff, maybe talk about what else you're seeing out there in the marketplace after Ed talks about what they're doing.
That's an interesting question because we started off and we're still using Ethereum as our blockchain. ERC 1400 is the protocol of our tokens. But as we're looking at the international markets, such as, we opened an office in Lagos, Nigeria to really capture that central Western African region, which is a very popular region for cryptocurrency, but also Vietnam is a super active market for cryptocurrencies. There are other exchanges that use less costly blockchain protocols. So for example, BSC, which is a Binance protocol, or the most recent one now is FTX with Solana protocol. We are also going to be minting in those protocols so that we can do overseas transactions. And the reason for it is because overseas, $50 or $100 is a lot of money for certain investors. And if they had to pay gas fees in Ethereum, that's $35 on a $150 transaction, that eats into their investment. So we realize that's a problem. In the United States, if we have minimums of $10,000 purchases and allocation, and you have a $35 or $45 gas fee, not as bad. But if you start talking about smaller transactions, the gas fees can actually become preventative for doing deals. So we are going to start, it's kind of technical, wrapping tokens so that they can be traded in those markets and also have less gas fees involved.
Yeah, and what Ed is pointing to is his firm is working very closely with extremely well-heeled technology firms who are in the space. So it's a perfect intersection of addressing real estate, but also addressing it through excellent technologies. So it's complex. It's actually, there's a fair amount of complexity with the blockchains and integration as well.
Yeah, we've seen the same progression. Early stages, everyone was issuing using Ethereum. Now people are looking for alternative blockchains that are inexpensive as far as transactions. And it's not, it's not siloed to the tokenization industry. If we expand it to, NFT platforms, we see people are starting to issue NFTs on different blockchains because it's just, to issue one NFT for $90 on Ethereum is quite costly. And so it's a problem that's really presented to a lot of tokenized activities.
Yep. It's equivalent to charging somebody $35 to issue them a certificate.
Right, exactly.
It's equivalent to that. And I come from the more traditional side of the securities business, and those rails have gotten a lot cheaper because of the high volumes. Mm-hmm. So these rails that we're talking about for settlement, clearance, and ownership and all that kind of stuff eventually is going to converge. And a lot of Wall Street is starting to convert into these rails. So there's an interesting thing that's going on from an industry standpoint in financial services.
But like you said, there is a lot of technology that's coming out that's bridging Ethereum into other protocols to make it less less costly in terms of gas fees. So that's happening as we speak, just to make it more attractive for investors and users.
Yeah, and Jeff, you mentioned institutions starting to move into that space. We've seen JPM coin, so JP Morgan using permission blockchains to move money around more efficiently for institutional clients. So that's a perfect example, and I think we're going to continue to see that as these.
And they use industrial blockchains like Hyperledger. There are certain technologies which are designed for high speed. Ethereum is not the fastest thing out there. So, but if you're issuing basically private securities, you're not really worried about if this thing is going to take a couple of nanoseconds to get done. But as the volumes grow, also the needs for the blockchains to be able to operate faster is equally as important. And also security and all. This is a whole complex area, but it's also the very area that's enabling exactly what Red Swan is doing.
Well, think about it though. I laugh when they talk about speed because speed is relative, right? We think that we're making significant improvements to the industry because typically on a normal transaction it could take 6 to 9 months to close, right? But now we're actually able to transfer ownership in 6 or 7 minutes, right? So whether it be now 6 or 7 seconds, it's much faster, but still much faster than it used to be.
Yeah, understood. You're not doing high frequency trading in this sense.
Yeah, not yet. I mean, when you get there.
Anyway.
Yeah. So to close the loop on the blockchain, What the ones that I heard were Ethereum, Solana, and you said BTS.
BSC, Binance.
Okay. Are there any other ones that people should pay attention to? People who are super interested in this tokenization space, like let's round out the list. If there's any others that people are seriously considering in the industry. I heard
Those will be the top three. I think those will be the top three in terms of frequency trading around the world. So that we utilize, you're with those three, I think could be pretty secure.
And what he's talking about is public blockchains. So
Correct.
they're accessible across nodes. The technologies I raised are basically blockchain technologies for larger institutions. They're private. So the technologies, Red Swan is architecting around public, so because of the ability to get to a broader base. So, and this evolves through time. So Ethereum started it all. I mean, that protocol that Ed is describing is the baseline way of describing a security, and that's actually carried across.
True, because all the other ones are not necessarily compliant with the regulations for issuing securities, where ERC 1400, ERC 20 is very compliant for meeting the regulatory compliance, whereas BSC may not be here in the United States.
Tyler, you were going to say something?
I was going to say, as far as efficiencies, Algorand has become very popular as a blockchain. I haven't seen any securities issued, and I'm not sure about the compatibility, but that's been a very popular blockchain in place, especially people in the NFT space are looking at that as an alternative option to Ethereum.
I've had one or two project teams from the UK ping me utilizing Algorand, looking for securities. So it's probably started to evolve there.
Yeah, now that I think of it, there was a raise for a company that was issuing NFT art, and their securities were, it wasn't just their NFTs on Algorand, it was their securities were using Algorand as well. So correct me.
Okay, it evolves through time.
Yeah,
the rails are changing.
Daily.
Yeah, and I had heard of one other fund. There's a fund called Liberty Fund, started by Michael Flight, who's also kind of a pioneer and leading the charge. That the last conversation I had, they were seriously considering Algorand. So I've heard that before, long story short. I think we have time for one more question. And I think maybe we'll end here because we just haven't covered it, which is, there was a question at the very beginning about, hey, wait, tokenization, that doesn't sound like too much of an innovation. Isn't there these things called deeds that
they haven't been tokenized yet.
Get traded. So
they're sitting at a county record somewhere.
Yeah,
that's ripe. If we can get there, we haven't gotten there, and it's political. Those records at the state level, the county levels, the ledgers, well, they're private. They're run by the states. I'm sorry to overstep that, but that's exactly that is an opportunity.
Totally. But there is a workaround where there people are selling real estate via NFTs. So Ed, you want to talk about that for a second?
Well, basically, you still have to verify the deed to know the ownership, and then you can now transfer that ownership to the blockchain, right? So that is the base case initially. But once it's transferred to the blockchain, that deed can be thrown away. You don't need it anymore because it's already been verified and now it's on the blockchain. So I think everything is going to be moving in that direction. You have companies that are starting to put the infrastructure together to be like a title company, so to speak. So they have all the records and for all the properties with residential and commercial. But I think that it's easier, once you have something recorded. So we want to make sure we look at the deed, verify the ownership, and then record it in the blockchain. And then now we can trade those transactions without going through all the expense that you had to verify every time you want to buy either a share or the whole property. You have to go verify that each time, which costs you money. Now, when it's done once, you can feel very comfortable that you're trading something that has been verified and that has gone through the regulatory rails, and that you can now move your ownership between yourself and another party without having to bring another third party involved. Yeah.
And for people interested, there's a cool company operating at the forefront of this called Proppy, and they've done one transaction in the Ukraine, actually, before all this madness started. And then they did a transaction recently involving a house in Tampa Bay, where the house was basically put into an LLC, and that LLC ownership is reflected on
Right.
an
And
NFT.
because the underlying deed itself is tied to the LLC, but that's static.
Yeah,
It's a shadow, but it is a solution.
Also, I think it's important to note that the NFTs are not digital securities. And so therefore you cannot use an NFT to sell and break up shares of a digital asset like we're doing with Red Swan, because once you start getting into investment assets and you now are trying to sell that, you have to go through the regulatory rails. And the NFTs are, if you want to transfer a ownership title for a condo or a house or anything with NFT, that's possible from the asset to the person, right? But you want to break it up into an investment asset where they're now going to receive dividends and equity returns, that becomes a security. And so therefore there's a distinction there between, doing digital securities for security token offerings or issuing NFTs to transfer real estate.
Yep.
Eventually we'll be doing both, but I'm just making sure that everyone knows there's a big distinction between the two.
Yeah, it's important. Totally. Well, gentlemen, this was a really fun conversation. Thank you for taking the time. Parisa, I'll turn it back over to you.
Good. Thank you all so much. Thank you to Nick, Ed, Jeff, and Tyler for today's webinar, and to all of you who joined. It was a great conversation. As mentioned at the start, we'll share the recording with our registered members, and our past recordings are available on the website. Thank you to everyone for today's discussion, and we hope to see you again soon.
Thank you very much. Pleasure.
Thank you.